Hey guys, Brad with the bottom line here, where we get right to what matters and break it down as simple as possible for you. Just wanted to go over the recent news on Kraft Heinz that caused the stock to plummet almost 30% in one day. Overall, if you had the name Kraft, it was probably not a good Friday for you. Patriots owner Robert Kraft had some bad news break on him as well. He was paying for a little extra work at the massage parlor, but he does not actually have any association with the Kraft Heinz brand. But anyways, let's get into it. Here is the stock chart for the last year. You can see that overall it's performed very poorly in the past year, about 50% down. And on February 22nd, that was Friday, they had a huge steep drop, losing about $17 billion in market value. So, if you don't know, Kraft Heinz Co. is one of the largest food companies in the U.S. and the world. They formed in 2015 when Kraft and Heinz merged together. So you can see on the right some of the big name brands they own: Oscar Mayer, Kraft Mac and Cheese, Kool-Aid, Jell-O, Capri Sun, Planters, Lunchables. They own them all. And the company as a whole is owned largely by Warren Buffett's Berkshire Hathaway and 3G. So what went wrong? Well, a lot went wrong. First off, they experienced a huge loss of $12.61 billion in Q4 versus about an $8 billion profit last Q4. This was largely due to a $15 billion write-off on the intangible assets of Kraft and Oscar Mayer. And this caused their earnings per share number to be a huge negative number, over $10 per share. They also cut their dividend from 64.5 cents to 40 cents, as well as a SEC investigation into KHC's accounting practices. So a lot of bad news, just paired with general stagnating revenues, decreasing margins, and brand erosion. So if you look at the chart on the right, you can see these stagnating revenues in orange, and on the bottom graph that shows earnings before interest, tax, depreciation, and amortization, you can see that these margins have taken a pretty big hit in the past year as well. So why did things go wrong, and what's going to happen moving forward? Well, KHC did not capitalize on a consumer trend towards less processed foods and more organic foods. They most of their brands, as you can see, are still all processed foods. A lot of their competitors, General Mills being one of them, acquired Annie's, an organic food company. So they were making moves in order to better meet this consumer trend, which KHC failed to recognize and ultimately is paying the price for now. They also placed extreme emphasis on cost-cutting after the merger in 2015, and this was to improve margins. However, it probably ended up hurting the company more than helping by putting a chokehold on the marketing and future product development and acquisition. Moving forward, they say that consolidation and more acquisitions is a part of their strategy. However, they hold a lot of debt. Their margins and cash flow are shrinking. So this is going to be a hard thing to achieve, as well as altering their brand image from being one of processed foods to a more health-conscious image. So a couple takeaways from all of this. First, it's important for companies and investors to identify and adapt to consumer trends. So as an investor, if you saw this health trend that's been going on for quite a while, you'd probably want to not invest in KHC, who is failing to do the same. Focus on cost control is important, but not to the point of harming the business. And lastly, just because the stock is trading at low levels, so before Friday, the stock was still down a lot on the year. It also had a high dividend yield, over 4%. And you might say, Warren Buffett owns a large share, it must be a good company to be in. Just because all those three things does not make it a safe investment or a good investment. So that's something that you always want to consider. That's all I got for you today. If you enjoyed the video, please leave a like and subscribe. And until next time, I hope you guys have a great day. Thanks.